Stop. Put the other tabs aside for a minute, because what you're looking at right now is not background noise, not a cute little breakout, and not another metals bugs are finally getting their day moment. This is not a normal rally, not a healthy pullback, not a trade you scalp off a 5-minute chart. It's a stress signal. And on January 6th, 2026, two things happened at the same time that almost never line up unless the system is slipping into a different phase. One, silver printed a headline number that makes the suits uncomfortable to even say out loud, $80 on the screen in broad daylight. Two, Bank of America, yes, that Bank of America, put numbers on paper that read like a surrender note from the same institutions that spent years telling you metals were a pet rock. And then quietly, while everyone's eyes were glued to that $80 handle, like it was the finish line, China tightened a valve that most people don't even know exists. A policy lever, a gate, a permission structure around silver flows. So ask yourself, when price jumps, a major US bank suddenly turns bullish with extreme targets, and the East starts adjusting the plumbing on physical metal at the same time. What does that tell you? It tells you this isn't about up or down anymore. It's about who gets metal, who gets paper, and what happens when the market realizes those are not the same thing. Because I've seen this movie. Different actors, same script. In 2008, it was contained, then it was liquidity, then it was the Fed has tools, and then, all at once, it was a global margin call where everybody learned the difference between owning something and owning a claim on something. In the metals market, it has its own version of that lesson. The Hunt brothers, the Great Squeezes, the nickel episode where the market broke, trading got halted, and the people who thought they were hedged found out they were just holding a promise from a stressed counterparty. Palladium going vertical when the physical side stopped cooperating with the paper narrative. So when you hear $80, don't clap, don't celebrate, don't treat it like a trophy. Treat it like a siren. Because the real question isn't whether silver can go higher. The real question is whether you understand what $80 even means in this kind of tape, in this kind of world, with this kind of institutional behavior happening behind the curtain. And that's where we have to start, not with your chart, with their behavior. Bank of America. I want you to feel the weight of that name. Not the marketing, not the logo, the machinery, the desks, the research apparatus, the client calls, the risk managers who have to sign off on every sentence that goes out the door. These institutions don't just get excited. They don't wake up one morning and decide to hype gold like a YouTuber. When a bank like that moves its official framing, it's because the internal probabilities have shifted. The math has shifted, the political cover has shifted, and the number they floated for gold, an average price around $4,538 an ounce in 2026, doesn't read like a casual adjustment. It reads like an admission that the old regime is unstable. That's not we like gold, that's we don't like what's happening to everything else. Because a gold number like that isn't just a commodity call, it's a currency call, it's a bond call, it's a credibility call, and then comes the part that makes metals people either giddy or reckless. The silver scenarios, here's where you need to keep your head. A lot of people heard the most extreme version, the most viral version, the version that gets clipped into a thumbnail and screamed into your feed. $3,000 an ounce, $3,900. Numbers so big they stop being numbers and start being hypnosis. But when you go back to what was actually being discussed, what keeps popping up are historical ratio-based scenarios that put silver in a high double-digit to triple-digit range with an upper scenario in the low hundreds. Numbers like 135, 200, 300, depending on which historical anchor you use and which macro assumptions you feed into the model. That's still explosive. That's still world-changing for a metal that most people treat like an industrial footnote. But the point isn't the exact dollar figure. The point is the shift. The point is the direction and the timing. The point is that an institution that has lived comfortably inside the paper framework is now publicly entertaining a world where the paper framework can keep the lid on forever. That's not a price prediction. That's a psychological pivot. And in markets, psychology is the first crack you see before the foundation gives way. Because what does a bank actually do when it senses a regime change? It repositions its narrative in advance. It creates future "I told you so" cover. It makes sure that when the crowd finally panics, the bank doesn't look like it was asleep at the wheel. It looks like it was early. And this isn't about them joining your team. This is about them choosing which side of history they want to be standing on when the cameras turn on. Now, let's talk about that $80 print, because that number is doing something to people's brains that is dangerous. You're seeing it on the screen, and your mind wants to round it off. You want to say, we did it, we're here. 80 is basically 100. No. In a stressed market, the difference between 80 and 100 isn't $20. It's an entire phase transition. It is the difference between the paper market still has authority and the physical market has started ignoring the paper market. That's not semantics. That's life and death for anyone who is short promises. And you can see the tell in one place that never lies for long: premiums and availability. In a healthy market, premiums are an inconvenience, a few bucks, a normal friction layer between wholesale and retail. In an unhealthy market, premiums become a confession. Because when the screen says $80 and the real world says, sure, if you can find it, you're looking at a credibility gap. You're looking at two markets trying to pretend they are one, and that never lasts. Either the paper price rises to meet physical reality, or the physical side goes dark and the paper market becomes a casino chip that nobody accepts outside the building. That's not drama. That's how commodity markets behave when the underlying plumbing is stressed. Now, I can already hear the objection, the comfortable objection. Retail is always messy. Coins have higher premiums. Dealers can run out. Online inventories fluctuate. Yes, all true. But here's the pivot you need to understand. When you get persistent, widening gaps while the headline price is moving fast, it's not just retail friction anymore. It's a signal that the market is rationing metal, not pricing metal. Rationing. And a rationing market is not a market that politely follows charts. It's a market that starts setting rules based on scarcity. So ask yourself, if this is just a normal rally, why does it feel like people are scrambling? Why do you hear the same phrases over and over? No inventory, allocation, limits, delays, call for quote, back order. Those are not the words of a calm supply chain. Those are the words of a system protecting itself from depletion. Now we move from the headline to the machinery. Bank positioning. This is where the internet loves to turn everything into a monster story. Banks are short 4.4 billion ounces. 550% of annual production. It's mathematically impossible. Listen carefully. There is real leverage in silver. There is concentrated positioning. There is a long history of the paper market overpowering the physical narrative, especially in quiet periods when most people stopped caring. But when you start throwing around multi-billion ounce net short numbers like they're official, you lose credibility. You hand your enemy the easiest rebuttal in the world. And the reality, based on official positioning snapshots like the Bank Participation Report, looks different in scale, even if it still looks dangerous in structure. What you see is tens of thousands of contracts on the short side, held by banks offset by a smaller long side, leaving a net short that can translate into something like a couple 100 million ounces when you convert contracts into ounces. A couple 100 million ounces is not 4 billion, but don't make the mistake of thinking that means safe. Because in a market this tight, with this kind of sentiment shift and this kind of supply sensitivity, a couple 100 million ounces is not a rounding error. It's a loaded gun. Here's why. Futures markets are built on the assumption that most contracts don't go to delivery. They're rolled, they're netted, they're cash managed. It's a game of musical chairs played with spreadsheets. That game works as long as everyone agrees that cash is an acceptable substitute for metal. The moment big buyers start saying, no, we want the bar, the entire tone changes. Because now the short isn't just a mark-to-market problem, it's a sourcing problem. And a sourcing problem in silver is brutal, because silver is not like printing money, and it's not even like gold. Gold sits in vaults as a monetary asset. It's hoarded. It's recycled. It's owned as a store of value. It's above ground, and it stays above ground. Silver gets consumed. Silver gets embedded in things: panels, electronics, medical, defense, industrial processes. It disappears into the real economy, and it does not politely come back when you need it. That's your first structural break. This isn't a stock. This is an industrial metal with a monetary shadow, and that combination is exactly what makes it dangerous when the world starts repricing trust. Now fold in the supply side, because this is where the story stops being speculative and starts being mechanical. Global mine production is roughly in the neighborhood of 800 million ounces a year, give or take. The exact number wiggles, but the point doesn't. It's not infinite. It's not responsive on a dime. You can't just make more silver because price moved on a screen. Mines are not factories. A factory can add a shift. A mine needs permits, geology, capex, equipment, energy, labor, time, and a decade of patience before the first meaningful ton comes out of the ground. So when people say, if silver goes higher, miners will produce more, they're thinking like someone who has never watched a commodity cycle up close. Price can change in a week. Supply changes in years. That's the mismatch. That's the trap. And there's another layer most people miss. A large chunk of silver doesn't even come from primary silver mines. It comes as a byproduct of mining for other things: lead, zinc, copper. So silver supply is, in a very real way, hostage to the broader industrial cycle. If base metal demand slows, operations shut down, and silver supply can fall even if silver demand is rising. That's not a theory. That's how byproduct metals behave. So you've got a market where supply is inelastic, demand can surge, and the paper positioning is built on the assumption that physical settlement is rare. All three of those conditions are manageable in calm times. All three become lethal when sentiment flips. Now bring in the East, because this is where the public story gets confused, and confusion is exactly where risk hides. You've heard the number. China printed 48 trillion. Sounds like an explosion, sounds like a monetary nuke, sounds like they hit a button and flooded the world with cash in a week. But here, that's the reality that gets lost in the shouting. That 48 trillion figure is essentially the rough. US dollar equivalent of China's M2, its broad money supply, depending on the exchange rate you use. That's not a weekly injection. That's the scale of the money base. Still enormous, still meaningful, still a reflection of a system that has had to expand liquidity to keep the machine running. But if you treat the size of the tank like it was, the amount of fuel poured in today, you misread what's happening. And misreading is how people get slaughtered. So why does China matter in this story if the 48 trillion number is being abused? Because China doesn't have to print a new 48 trillion this week to change the silver market. China just has to change the rules of flow. And that is exactly what we saw as 2026 began. A tightening of export controls done in ours, and licensing structures around silver, mechanisms that signal very plainly this is strategic and the state wants visibility and control. That's not a meme, that's policy. And policy is how governments fight wars without firing a shot. Because think about what export licensing means in a metal market. It means the state has placed a gate in the pipeline. It means supply to the outside world is no longer just a matter of price and contracts. It's a matter of permission. Permission. That's a word that should make every market participant sit up straight, because markets can deal with price volatility. Markets cannot deal with political throttling when inventories are already tight. And this is the part where the Western narrative gets exposed. The West likes to pretend commodities are just inputs. A little inflation here, a little CPI there, some supply chain noise. China treats commodities as strategic collateral. Oil, copper, grain, and yes, precious metals. So the real question isn't whether China is buying everything at any price, like a cartoon villain. The real question is whether China is building a floor under physical metals by treating them as national balance sheet assets. Because if they are, the paper market's ability to scare metal out of weak hands starts to fail. And when that ability fails, shorts lose their exit. That's the end game. The shorts don't die because price goes up. They die because metal stops showing up. Now look back at Bank of America's shift through that lens. A bank doesn't need to be trapped short, in some comic book sense, to recognize a tightening physical market with changing policy flows and rising demand sensitivity. All it needs is a model that starts spitting out ugly probabilities. All it needs is a risk meeting where someone says quietly, if the physical market keeps tightening, our assumptions about liquidity and settlement stress are wrong. And when that sentence gets said inside a major institution, the next sentence is always the same. Adjust the narrative. Because narrative is how institutions manage crowd behavior. It's how they reduce their own shock risk. If you can get the public to think the move is normal, you buy time. If you can get the public to think $80 is expensive, you encourage selling. If you can get the public to believe the squeeze already happened, you reduce the chance of a delivery panic. That's not conspiracy. That's market psychology. Now, let us talk about the most dangerous idea floating around right now, the 80 trap. Not because I want to hype you into fear, but because I want you to understand the mechanism. A trap doesn't have to be a coordinated plot. A trap can simply be the natural outcome of two markets diverging. Paper trades an enormous size. It trades fast. It trades on leverage. It trades on sentiment, on algorithms, on time zones. Physical trades slower. It's constrained by inventory, by fabrication, by shipping, by vaulting, by real money changing hands for real metal. When the paper market wants to cap a move, it can do it with selling pressure, contracts, liquidity, momentum breaks. When the physical market wants to cap a move, it can't sell what it doesn't have. So the paper can suppress the screen for a while, even as the physical side tightens. And that creates the illusion that the real price is stable while availability collapses. That is the trap. Because humans anchor on the number they can see. You can see $80. You can't see the dealer's empty shelf until you call. You can't see the refinery throughput until months later. You can't see the quiet hoarding until it shows up as a sudden shortage. So the public celebrates the screen while the insiders watch the flow. And when the flow is what matters, the people who watch the flow always win. This is why the difference between spot and current street matters so much right now. It's not just a premium. It's a measure of trust. It is a measure of how much the market believes the paper promise is convertible into the real thing. And when that belief starts to crack, the whole structure starts to hum in a different frequency. You can feel it. In the way headlines change, in the way banks start hedging their language, in the way analysts suddenly find reasons to like what they used to mock, in the way policy quietly tightens around strategic resources. This isn't a bull market. This is a credibility test. Now, I am going to slow down for a second and make sure you don't walk into the most common psychological mistake here. When people hear ratio targets and triple digits, they start building fantasies. They start imagining a straight line. They start thinking the market will politely climb, giving them time to decide, time to trade, time to outsmart it. No, in metals, when the tape gets tight, you don't get a straight line. You get air pockets, you get gapping behavior, you get limit moves, you get weekends where one market closes and another opens with a different reality. You get sudden rule changes and emergency measures and temporary trading adjustments that are anything but temporary. That's not fear-mongering, that's pattern recognition. I watched it in other corners of the commodity complex, and every time people said, that can't happen here, then it did. So if your plan depends on perfect execution, sell the top, buy the dip, rotate back in, you're making a plan that assumes a stable, liquid, continuous market. And the whole point of this moment is that stability is what's breaking. Now, let's bring it all together, because the threads aren't separate. They're feeding each other. Silver hits $80 and draws attention. Attention draws capital. Capital draws volatility. Volatility draws risk controls. Risk controls draw liquidity withdrawal. Liquidity withdrawal widens spreads. Wider spreads amplify the paper-physical disconnect. The disconnect forces more people to ask for physical. More physical requests stress inventories. Stress inventories force higher premiums and rationing. Rationing triggers more hoarding. Hoarding tightens supply further. That's the feedback loop. And you don't stop a feedback loop with a press release. You don't stop it with a talking head telling you everything is fine. You stop it by introducing supply. But supply, in silver, doesn't show up when you need it. That's why this feels like an endgame. Now look at the institutional layer again. If you are Bank of America and you are staring at this set of conditions, headline price spiking, physical stress creeping, Eastern policy tightening around flows, you don't have to be a villain to see what S coming. You just have to be sober. You just have to look at what happens when a market that relies on rollover behavior meets a buyer who doesn't T-roll. And that buyer doesn't have to be a cartoon China. It can be any entity that needs silver as an input and can't substitute it easily. Industrial demand, strategic demand, defense demand, energy transition demand. When demand becomes non-negotiable, price becomes violent. Because the buyer isn't buying for profit. The buyer is buying because the alternative is failure. A factory line stops. A project misses deadlines. A supply chain breaks. A national security program becomes dependent on someone else's stockpile. That's when metal stops behaving like a commodity and starts behaving like collateral. And collateral is what the monetary system runs on. Which brings us back to gold and why Bank of America's gold number is not a side story. Gold is the lie detector of the fiat system. It doesn't tell you which stock will go up next week. It tells you whether trust is being diluted. So when a major bank puts a 4,000 plus average on gold, it's quietly admitting that dilution is not a temporary phenomenon. It's structural. It's baked into how the system survives. Debt needs low rates need more liquidity needs credibility. Credibility requires someone to believe the promises will be honored in real terms. When that belief weakens, gold responds. And when gold responds hard, silver eventually stops being ignored, because silver is where monetary fear collides with industrial necessity. That collision is exactly what you're watching now. And here's the part most people don't want to admit, because it is uncomfortable. If this is the start of a regime change, then your real risk isn't missing the rally. Your real risk is owning the wrong form of exposure. A chart can go up, and you can still lose if you are reholding something that becomes unconvertible, illiquid, or politically constrained at the wrong moment. That's not hypothetical. That's happened across history in different clothes. Paper claims are fine until they aren't. And when they aren't, the transition happens faster than people think, because it's not gradual, it's not polite, it's a snap. Now, I'm not telling you, go do X like some carnival barker. I'm not telling you to sprint into anything blindly at a headline price, because that is how people get wrecked too. What I am telling you is to think like the people who built this machine. They don't think in terms of price, they think in terms of settlement, convertibility, counterparty risk, the ability to perform. And right now, the entire metals complex is whispering the same message. Performance is becoming the central issue again. That's what the spread is saying. That's what the policy tightening is saying. That's what the sudden bullish institutional framing is saying. This isn't just a rally. This is an argument about reality, and reality always wins, eventually. Not because it's moral, because it's physical. You can create infinite paper. You cannot create infinite ounces. So what happens next? If the $80 print was the first siren, the next phase is usually the phase where the market tries to calm you down. It tries to normalize the move. It tries to tell you the spike was speculative. It tries to convince you that the smart thing is to take profit, be rational, go back to comfort. And then the physical side tightens again. And then a policy headline drops. And then a bank raises targets again. And then some industrial buyer pays up quietly because they have to, and they don't want to advertise it. And then, one morning, the screen price gaps, and everyone who thought they would have time realizes time was the one thing they didn't have. That's the pattern. First in whispers, then in numbers, then all at once. So ask yourself seriously, if you misread this moment, what are you actually risking? Not your ego, not your FOMO, your savings, your purchasing power, your ability to exit a crowded room before the door narrows. Because in every crisis, the public fights the last war. They stare at old signals. They argue about the last headline. They call it a bubble or a conspiracy or fad. The insiders don't argue. They reposition. And the repositioning is what you're seeing in the weird alignment of these news items. The $80 print, the bank's extreme projections, the policy gate on silver flows, the reality of supply constraints, the persistent physical paper friction. Put it together, and you're not looking at a normal commodity cycle. You're looking at a market entering the terminal phase of a long-running distortion. A distortion where paper could bully price lower because physical was abundant enough and the world was complacent enough. But complacency is gone now. The monetary backdrop doesn't support it. The geopolitical backdrop doesn't support it. The supply chain backdrop doesn't support it. And once those backdrops shift, the old tricks don't stop working slowly. They stop working suddenly. That's the part that scares the risk managers. Not because they're evil, because they understand what a nonlinear move does to leverage. A nonlinear move turns hedges into liabilities. It turns managed positions into forced liquidations. It turns a column book into an emergency meeting. And when you see a major institution publicly building a bullish narrative, it was often because they were preparing their clients and themselves for a world where the old playbook is about to get torn up. Now, there's a final piece you need to hold in your mind, because it is the piece that decides whether this ends as a violent repricing or a slow grind. Trust. Not trust in the government, not trust in a bank, trust in the market's ability to clear. If the market can clear, if paper can still convert, if liquidity stays deep, if policy doesn't choke flows, then you get an ugly but orderly bull market. If the market can't clear, you don't get up. You get a snap. You get discontinuity. You get price behaving like a stressed currency, not a commodity. And that's why the quiet policy lever in China matters so much. It's not about one announcement. It's about what it signals, that the state is watching the metal, categorizing it, treating it as strategic, and inserting itself into the flow. That changes incentives everywhere. Producers start thinking twice. Traders start hoarding. Middlemen start widening spreads. And the Western paper machine starts finding fewer willing counterparties who will deliver real metal into a world that is increasingly hoarding it. That would be bad enough by itself. But it doesn't stop there. Because the moment the world starts treating metal as strategic collateral, every ounce has two buyers. The monetary buyer and the industrial buyer. The investor who wants insurance and the manufacturer who needs input. And when both show up at once, the market doesn't balance. It rations and prices. It tells you, in plain language, pay more or go without. And once a market starts doing that, the whole tone changes. You stop asking, what's the price? You start asking, is there any left? That's when the public finally wakes up. That's when the headlines get hysterical. That's when they bring out the experts who tell you it's too late. And that's when people who were calm at $30 panic at $120. It's always backward. So here's your decision point right now, while the screen still looks like a chart and not like a fire alarm. The real question isn't whether the next candle is green. The real question is whether you're positioned for a world where convertibility gets stressed. If you're holding nothing but paper claims, understand what happens when settlement becomes a negotiation. If you're holding physical, understand what paper chaos actually means for you. It doesn't mean sell because it S up. It means recognize why the system is trying to coax metal back into circulation. Because that's what happens in the late phase. The system tries to buy time by pulling real collateral back inside the perimeter. And you can feel that attempt in the way the market is presenting you an attractive number on a screen while the street reality refuses to cooperate. That's not a coincidence. That's how stressed systems behave. They offer you comfort right before they change the rules. So don't confuse the headline with the endgame. January 6th, 2026 wasn't the finish line. It was the first public crack. A major bank put extreme numbers on paper. Silver printed a psychologically violent handle. China adjusted the policy plumbing around a strategic metal. The physical market kept whispering that availability matters more than charts. That's not a collection of random stories. That's a single story. told in different languages, and if you're paying attention, you can hear it. The system is slipping into a different phase. Not next year, not someday, now. And if you wait until the evening news understands what this means, you will be the last one moving in a crowded room. In markets like this, you don't get decades. You barely get years. Sometimes you only get weeks. Watch the spreads. Watch the policy levers. Watch how institutions change their language. Watch what happens when the screen says one thing and reality says another. Because when that gap becomes the headline, the repricing won't be polite. It will be a snap. And you don't want to be holding the wrong kind of promise when it does. That's your warning.